Trading is often presented as a game of numbers, probabilities, and precision. Charts, indicators, data feeds, these are the visible instruments of the trader's craft. Yet beneath the surface, behind every entry and exit, lies a far more unpredictable instrument, the human mind. Trading is not just an intellectual pursuit, it is an emotional experiment played out in real time. Every flicker of a price chart awakens something within us. Curiosity, greed, fear, hope, and how we respond to these internal impulses determines whether we thrive or falter. The dual nature of trading psychology begins with this paradox. Trading demands logic, yet it continuously provokes emotion. On one hand, the trader must act as a rational analyst, assessing data, identifying trends, and managing risk with mechanical detachment. On the other, they are humans subject to the same primal instincts that have guided survival for millennia. In the prehistoric world, emotion was a tool for survival. Fear kept us away from danger, excitement motivated pursuit, but in the modern marketplace, these instincts can turn against us. The very emotions that once saved us now sabotage our judgment. The first challenge a trader faces is recognizing that markets are not merely systems of supply and demand. They are mirrors reflecting collective psychology. Every candle on a chart represents not just a transaction but an emotional consensus, a pulse of fear and greed moving through millions of minds simultaneously. When a trader enters the market, they are not competing only with algorithms and professionals. They are competing with the aggregated emotion of the crowd. This emotional atmosphere is contagious. It lures the rational mind into irrational territory. One moment you are calculating risk, the next you are chasing price movements because you feel left behind. Trading psychology, therefore, exists on two planes, internal and external. Internally, the trader wrestles with personal impulses, impatience, self-doubt, overconfidence, and revenge. Externally, they face the mass emotion of the market, which can amplify their own. When the market surges, euphoria rises. When it crashes, panic spreads. This dual-layered environment creates emotional feedback loops that distort perception and erode discipline. The trader must learn to see both the emotion within and the emotion without to navigate the chaos with clarity. In the early stages of trading, most people are seduced by the intellectual side. They learn about technical analysis, study chart patterns, and memorize risk management rules. It feels scientific, almost mechanical. But as soon as real money is involved, the illusion of control begins to crack. Paper trading feels safe because there is no emotional weight. The moment capital is at stake, the emotional circuitry lights up. Now, every decision carries a psychological cost. A trader may find themselves deviating from their strategy for reasons they can't explain. They may hold losing positions longer than they should, or exit winning ones too soon. It's not the lack of knowledge causing these errors, it's the interference of emotion. The dual nature of trading is most evident when a trader begins to experience conflicting states. The logical mind says one thing while the emotional body says another. You might know that averaging down is risky, yet you do it anyway because you feel the market will reverse. You might plan to follow a stop loss, yet cancel it at the last second because you believe the market is just testing support. These are not lapses of intelligence, but lapses of emotional regulation. The analytical brain has been hijacked by the emotional brain, and the trader becomes reactive rather than responsive. Understanding this interplay requires awareness of how the human brain functions under stress. The limbic system, responsible for emotion, evolved long before the neocortex, which governs logic and reason. In moments of high pressure, such as watching a position move rapidly against you, the limbic system overrides rational thought. This is the fight-or-flight response, a primitive mechanism that helped our ancestors survive but has no place in trading. The body floods with adrenaline and cortisol. The heartbeat accelerates. Decision-making becomes impulsive. The market, in this sense, becomes a psychological trigger. A digital jungle that constantly tests emotional endurance. Professional traders understand that success depends less on predicting the market and more on mastering their own psychological reactions. The data is available to everyone. The edge lies in how one interprets and acts on it under emotional stress. That's why two traders can look at the same chart and see different opportunities. One sees risk and hesitates, the other sees potential and acts. The difference isn't in the chart, it's in their internal state. The disciplined trader has learned to process emotion without being consumed by it. The undisciplined one becomes entangled in it, mistaking feeling for fact. One of the most revealing aspects of trading psychology is how it exposes the trader's relationship with uncertainty. Humans crave certainty. We want to believe that patterns repeat, that cause leads to effect, that effort guarantees reward. But the market doesn't obey such simplicity. It is probabilistic, not predictable. Every trade carries risk, every setup can fail. The rational mind understands this, but emotionally, we struggle to accept it. This is why traders overanalyze not to gain more information, but to reduce the discomfort of uncertainty. They seek the illusion of control in a system that offers none. This emotional tension between logic and uncertainty creates psychological exhaustion. The trader begins to oscillate between two extremes, hypervigilance and detachment. In one moment, they are obsessed with every tick of the market. In the next, they are emotionally numb, unable to engage. This is the mental whiplash that defines the emotional roller coaster. Over time, it erodes confidence, clarity, and patience. The mind becomes reactive, chasing comfort rather than consistency. Every loss feels personal, every win feels temporary, and the emotional pendulum never stops swinging. The dual nature of trading psychology also reveals itself through self-identity. Many traders unconsciously tie their self-worth to their trading performance. A profitable day affirms their intelligence, a losing streak questions their competence. This attachment makes objectivity impossible. Instead of seeing trades as probabilities, they become personal judgments. The trader stops evaluating trades, they start evaluating themselves. This self-identification amplifies every emotion. A loss is not just a number, it's a wound to the ego. A win is not just profit, it's proof of superiority. The market, indifferent as it is, becomes a mirror for the trader's insecurities and desires. Over time, some traders begin to recognize that trading is not merely about financial mastery but emotional evolution. The market forces introspection. It exposes impatience, greed, fear, arrogance, traits that might remain hidden in other professions. Each loss becomes a lesson not just in strategy but in self-awareness. Each success tests humility. The trader who understands this begins to see trading not as a way to conquer the market but as a way to understand themselves. They begin to separate who they are from what they do. They learn that emotional neutrality is not coldness but clarity, the ability to act without attachment. Yet achieving this state is not a single realization but a continuous discipline. Emotional mastery requires constant self-observation. It means catching the subtle cues before they escalate, the tension in your chest before a hasty entry, the urge to check charts compulsively after a loss, the quiet anxiety that whispers you must make it back. These are emotional tells, indicators as powerful as any technical tool. They reveal where your mind is leaning before your hand clicks the mouse. To a psychologically aware trader, these internal signals are as valuable as external ones. The duality also manifests in the social dimension of trading. The digital era has amplified exposure to other traders' results. Social media feeds filled with screenshots of profits, stories of overnight success, and promises of the perfect strategy create psychological distortion. Comparison fuels insecurity. The trader begins to trade not from their plan but from their perception of others' success. This external validation loop feeds emotional volatility. When others win, you feel inadequate. When you win, it never feels enough. The emotional mind seeks belonging and status, while the logical mind knows that trading is an individual pursuit. Reconciling these two perspectives becomes another battlefield. The key to understanding the dual nature of trading psychology lies in recognizing that both sides, logic and emotion, are necessary but must be balanced. Pure logic without emotion leads to mechanical indifference, stripping trading of its human insight. Pure emotion without logic leads to chaos, turning trading into gambling. The art lies in integration, allowing emotion to inform awareness but not dictate action. A trader who feels fear yet acts through reason has achieved alignment. They have not suppressed emotion, they have transcended it. This duality is what makes trading such a profound psychological mirror. It compresses the human experience into patterns of decision-making and consequence. Each trade becomes a microcosm of life: risk, reward, uncertainty, control, surrender. The emotional surges that come with trading mimic the ups and downs of existence itself. The ability to remain centered amidst these fluctuations becomes not just a trading skill but a life skill. When traders start to view the market as a reflection of their internal state rather than a force to be conquered, everything changes. The charts become less about prediction and more about presence. The focus shifts from outcomes to process, from reaction to awareness. This is the bridge between the analytical and the emotional. The space where a trader stops battling themselves and begins observing themselves. It is here, in this subtle awareness, that the first step off the emotional roller coaster truly begins. The emotional landscape of trading is not a straight path but a pendulum that swings violently between extremes. At one end lies euphoria, the intoxicating high of a winning trade, the illusion of mastery, the sense that the market is finally bending to your will. At the other end is despair, the hollow ache of a loss, the self-doubt, the sudden questioning of every decision that led to that point. This back and forth is what defines the psychological rhythm of most traders' journeys. It is the emotional roller coaster that few anticipate when they first begin and even fewer escape unscathed from. The cycle often begins with hope. A trader starts with a plan, perhaps a strategy that worked during backtesting or a setup that seemed reliable during paper trading. The excitement is clean, untouched by pain. Then comes the first win, a moment of pure euphoria. The trader feels validated, even vindicated. The hours of study and hesitation now seem justified. This win triggers a surge of dopamine, the brain's reward chemical, creating a powerful association between trading and emotional pleasure. The mind begins to crave this sensation, much like an addiction. Each profitable trade becomes a hit of excitement, reinforcing the belief that success is not just possible but imminent. However, this euphoria is deceptive. It whispers illusions of control. The trader begins to believe they have cracked the code, that they can predict the unpredictable. They may start to size up their trades, take on more risk, or deviate from their rules. The rational mind fades into the background as emotion takes the wheel. Winning feels effortless, and effort feels unnecessary. The trader becomes intoxicated by success, mistaking luck for skill. In this stage, overconfidence blooms, not as arrogance, but as emotional blindness. The trader stops analyzing and starts assuming. Then, inevitably, the market shifts. A setup fails. A reversal catches them off guard. The loss seems small at first, but it stings not because of the money, but because it shatters the illusion of control. This is the first crack in the euphoria. The trader feels surprise, then denial. They convince themselves it was a fluke, an exception to their brilliance. They take another trade, expecting to regain equilibrium. But when that one fails too, the mind begins to spiral. The same emotional energy that once fueled euphoria now mutates into anxiety. Losses hit deeper than wins elevate. This asymmetry is hardwired into human psychology. Behavioral economists call it loss aversion, the tendency to feel the pain of losing far more intensely than the joy of gaining. A trader who wins 3 trades and loses 1 might still end up emotionally negative, even if they are financially ahead. The reason is simple: a loss feels like rejection, a threat to self-image, an attack on the illusion of competence. And so, the emotional pendulum begins its downward swing. Euphoria gives way to despair. Despair in trading is not just sadness, it is identity collapse. The trader who once felt powerful now feels powerless. Every chart looks confusing. Every setup feels suspicious. Confidence evaporates, replaced by hesitation. The same hands that once clicked with precision now tremble with doubt. Each trade feels like a test of self-worth, and each loss deepens the wound. The mind begins to ruminate, replaying mistakes, questioning decisions, even rewriting memory to justify or condemn past choices. Despair is the point where logic retreats completely and emotion reigns unchecked. At this stage, traders often oscillate between 2 emotional defense mechanisms: revenge trading and paralysis. Revenge trading is the impulsive urge to get it back, to erase the pain of loss by forcing a win. It's driven by the same dopamine system that fuels addiction. The trader feels compelled to restore equilibrium, to reverse the emotional damage. They double their position, abandon their plan, and chase setups that don't exist. Sometimes, they get lucky and catch a quick recovery. This temporary relief reinforces the behavior, trapping them in a destructive loop. But more often, it leads to deeper losses and more despair. Paralysis, on the other hand, is the opposite response: emotional freezing. After a series of losses, some traders become afraid to act. They stare at charts for hours, unable to pull the trigger. The fear of another failure becomes stronger than the desire for a win. They tell themselves they're waiting for the perfect setup, but underneath lies avoidance. They no longer trust themselves. The emotional pendulum has swung so far toward despair that the idea of trading itself feels painful. The cycle of euphoria and despair can repeat endlessly. Each swing reinforces the other, creating a feedback loop that becomes psychologically addictive. Euphoria feeds risk-taking. Risk-taking feeds loss. Loss feeds despair. Despair feeds the need for redemption, which leads back to risk-taking. Traders caught in this loop are not trading the market, they are trading their emotions. The charts are just a stage on which their psychological drama plays out. This cycle is why trading can feel exhilarating one week and unbearable the next, why many traders burn out even when they have profitable strategies. From a psychological perspective, this cycle mirrors the behavior of reward and punishment conditioning. When rewards winning trades are intermittent and unpredictable, they create stronger attachments than consistent outcomes. This is the same principle that keeps gamblers hooked at slot machines. The uncertainty of reward magnifies anticipation, and anticipation itself becomes addictive. The trader begins to equate volatility with opportunity, mistaking emotional arousal for engagement. In truth, they are no longer responding to market signals but to biochemical cues. Euphoria is dangerous, not because it feels good, but because it distorts perception. Under its influence, traders see patterns that don't exist and ignore warnings that do. They reinterpret data to confirm their optimism, dismiss risk as temporary, and rationalize reckless decisions as intuition. The emotional high clouds the ability to differentiate between luck and skill. And because trading outcomes are probabilistic, even bad decisions can produce good results temporarily. This reinforces faulty behavior, planting seeds of future pain. When the market eventually punishes overconfidence, the fall into despair feels sudden, but it was inevitable from the start. Despair, on the other hand, brings its own distortions. It amplifies fear and narrows focus. The trader sees only risk, not opportunity. They obsess over past losses and project them into the future, convinced the market is against them. The mind catastrophizes, imagining worst-case scenarios, replaying emotional wounds, reliving each loss with fresh intensity. This mental replay keeps the body in a state of stress. Cortisol levels remain high, impairing memory, focus, and emotional regulation. The trader becomes trapped in their own biology, unable to separate the present trade from the ghosts of previous ones. The irony is that both euphoria and despair are reactions to the same underlying condition: attachment to outcome. The trader's emotions rise and fall in proportion to their identification with results. When trades go well, they feel validated. When they fail, they feel diminished. This attachment turns trading from a process into a personal narrative, a story of triumph and failure that the trader keeps rewriting with every tick of the market. The more emotionally invested they become, the more volatile their experience. The market becomes less a field of opportunity and more a mirror reflecting their psychological state. To observe this cycle clearly, one must understand the timing of its emotional transitions. After a major win, there is usually a brief period of calm, a deceptive pause before the next emotional surge. During this time, confidence quietly inflates, and risk tolerance expands. The trader might start justifying small deviations from their plan: a slightly larger position, a tighter stop, a quicker entry. These micro-decisions compound. Soon, what began as a moment of excitement turns into a shift in behavior. The trader's internal thermostat for risk has changed without their awareness. When losses eventually strike, the reaction is equally gradual at first. The trader rationalizes them: it's just a pullback. The market's being manipulated. I'll get it back on the next one. But beneath the surface, emotion is accumulating pressure. When the pain becomes undeniable, it erupts into full-blown despair. The trader feels not only financial loss but a psychological loss of control. In that moment, despair feels absolute, and the mind searches desperately for meaning or redemption. This is why revenge trading feels almost inevitable. It's not a choice but an emotional reflex, a way of reclaiming lost power. Some traders move through this cycle quickly, within a day or even hours. Others stretch it over weeks or months. The duration doesn't matter. What matters is recognition. The untrained trader believes the market is responsible for their emotions. The emotionally intelligent trader understands the market merely triggers them. The euphoria and despair were already latent within the market, just exposed them. This realization marks the beginning of self-awareness, though it often comes after much pain. It's worth noting that the cycle is not always visible from the outside. A trader can appear calm while experiencing intense internal turbulence. They may speak rationally about setups and risk management while silently battling emotional extremes. The inner voice fluctuates between overconfidence and self-loathing, between certainty and confusion. This hidden turmoil is what makes trading psychologically exhausting. It's not just the financial stakes, it's the constant emotional recalibration required to stay functional. Euphoria and despair are not separate states but two sides of the same coin. Both stem from emotional reactivity to market outcomes. The euphoria of winning is not true confidence but emotional inflation. The despair of losing is not true humility but emotional deflation. The pendulum swings between these extremes because the trader has not yet found equilibrium, the psychological balance that comes from detachment. Until that balance is achieved, every win will set the stage for the next fall, and every fall will fuel the next desperate climb. The human brain is wired to seek patterns of reward. When trading success arrives, it reinforces this wiring, creating an association between action and pleasure. The mind starts to equate trading frequency with satisfaction, not profit with discipline. This is why traders often overtrade after a win streak. The urge isn't financial, it's emotional. The mind wants another hit of dopamine, another confirmation of superiority. But the market does not reward emotional craving. It rewards patience, structure, and control, qualities that euphoria erodes. On the opposite side, despair breeds avoidance and rigidity. After a painful loss, traders tighten their strategies excessively, become fearful of taking risk, or even abandon trading altogether. The same brain that once overreached now underfunctions. The emotional memory of pain creates a feedback signal of hesitation. Each new setup becomes an emotional gamble, not on the chart, but in the trader's trust in themselves. The mind becomes cautious not because of logic but because of trauma. Thus, both euphoria and despair distort decision-making, just in different directions. Over time, some traders begin to notice that their biggest mistakes occur not during neutral periods but at emotional extremes. Their largest losses follow their biggest wins, and their longest drawdowns begin after streaks of overconfidence. This realization often comes only after repeated cycles, each one stripping away another layer of illusion. It's not the strategy that keeps failing, it's the trader's ability to remain psychologically centered within it. The market rewards those who can act from balance, not reaction. The emotional pendulum of euphoria and despair is therefore not just a byproduct of trading. It is the essence of it. Trading compresses the human experience of hope, fear, pride, and pain into rapid cycles of feedback and consequence. It tests emotional regulation more than intellectual knowledge. Those who misunderstand this think trading is about mastering the market. Those who see clearly realize it's about mastering themselves. Trading is not merely a battle of strategy, charts, and timing. It is a constant confrontation with one's own mind. The greatest adversary a trader faces is not the volatility of the market, but the invisible biases that shape perception, judgment, and action. These biases are psychological shortcuts, mental patterns that once helped humans survive uncertainty, but now distort reality in the realm of finance. Every trader, whether novice or seasoned, is vulnerable to them. They operate beneath awareness, subtly, influencing every decision, every interpretation of a chart, and every emotional response to gain or loss. Understanding cognitive biases is like turning the light inward, revealing the unseen forces that manipulate behavior and sabotage objectivity. The first and perhaps most pervasive of these biases is confirmation bias. It is the tendency to seek, interpret, and remember information that supports existing beliefs, while ignoring or dismissing evidence that contradicts them. In trading, this bias manifests in countless ways. A trader who believes a particular stock will rise scans the charts not for balance but for validation. Every bullish candle is seen as proof, every pullback rationalized as temporary. The mind filters reality through the lens of expectation. Even when clear signs of reversal appear, the trader may refuse to see them, convinced the market is wrong and they are right. This is not stubbornness. It is the brain's natural defense mechanism against cognitive dissonance, the discomfort of holding two conflicting truths. To protect self-image, the trader unconsciously distorts perception to maintain emotional comfort, even at the expense of accuracy. Confirmation bias does not act alone, it partners with the illusion of knowledge. Traders often believe that more information leads to better decisions. They devour news, watch indicators, scroll through analysis threads, and accumulate data until it feels like understanding. But the brain confuses quantity with quality. The more information we collect, the stronger our sense of certainty, even if that information is redundant or misleading. This is dangerous in trading, because markets are probabilistic, not deterministic. No amount of data can remove uncertainty. Yet the illusion of knowledge feeds overconfidence, leading traders to take larger risks under the false belief that they have figured it out. When the inevitable loss occurs, it feels personal, as though the market has betrayed them, when in truth it was their own bias disguising ignorance as insight. Another powerful cognitive distortion that governs trading decisions is loss aversion. The tendency to feel the pain of loss more intensely than the pleasure of equivalent gain. Studies in behavioral economics show that losing $100 hurts roughly twice as much as gaining $100 feels good. In trading, this bias creates emotional asymmetry. Traders cut winners too early to lock in profit, while holding losers too long in the hope they will turn around. The logic is paradoxical but deeply human. We prefer the illusion of control in loss over the vulnerability of accepting defeat. This bias is the root of countless blown accounts. It keeps traders anchored to losing positions, long after logic dictates they should exit. The pain of realizing a loss forces the brain to construct rationalizations. It'll bounce. I'm just waiting for confirmation, I'll close it when I break even. Each of these statements is not a trading plan but a defense mechanism protecting the ego from emotional pain. Closely tied to loss aversion is the sunk cost fallacy, the tendency to continue a losing course of action because of the resources already invested. In trading, this often appears as emotional attachment to a position. A trader may have entered a trade with solid reasoning, but when it turns against them, they hesitate to exit. The mind whispers, "You've already put so much into this, it can't be for nothing." They add to the position, convincing themselves they're averaging down when, in reality, they're deepening commitment to a mistake. The market becomes an emotional relationship, one the trader cannot bear to abandon. The sunk cost fallacy transforms rational strategy into irrational persistence. The longer the loss lingers, the stronger the psychological bond becomes, as if enduring the pain somehow increases the chance of redemption. But markets have no memory, no loyalty. The fallacy exists only in the trader's mind. Another subtle but destructive bias is the availability heuristic, the tendency to judge probabilities based on the ease with which examples come to mind. A trader who recently experienced a huge gain might overestimate the likelihood of repeating it. A trader who suffered a sharp loss might overestimate the risk of failure. The brain uses emotional memory as a shortcut for risk assessment. This is why a streak of wins often breeds recklessness, while a streak of losses breeds hesitation. Both are distortions. The emotional weight of recent events colors perception of probability, making the trader blind to actual statistics. In a sense, traders are constantly fighting ghosts, the memory of their last big win or their most painful loss. These memories shape decisions far more than real-time market data. Overconfidence bias is another silent killer of consistency. After a series of successful trades, traders begin to believe their intuition is superior. they start trusting gut feeling over analysis. Confidence, once built on logic, mutates into emotional arrogance. The trader feels they can read the market, that they possess insight others lack. But intuition in trading is dangerous when untempered by discipline. What feels like instinct is often just subconscious pattern recognition biased by recent experience. The market may reward this illusion temporarily, reinforcing the behavior, but eventually it punishes it brutally. Overconfidence leads to over-leverage, under-preparation, and overexposure. The very confidence that once seemed like a strength becomes the reason for collapse. Then there is recency bias, the tendency to give disproportionate weight to recent events over historical data. A trader who just suffered a drawdown may alter their entire strategy because of a bad week, forgetting that long-term performance matters more than short-term fluctuations. Similarly, a trader coming off a winning streak may increase position size because the market feels easy right now. Both responses are emotional, not analytical. Recency bias distorts perception of probability, making short-term outcomes appear more significant than they are. It tricks traders into reacting rather than planning, abandoning systems that work because of temporary discomfort or overconfidence. In the long run, this bias erodes trust both in the strategy and in oneself. The anchoring bias also plays a quiet but powerful role. When traders see a price at a certain level, they tend to anchor their expectations around it. If a stock once traded at $100 and is now at $70, the mind assumes it's cheap simply because of the previous price. This assumption ignores changing market conditions, fundamentals, and sentiment. The anchor becomes a psychological reference point that shapes decisions irrationally. Similarly, traders may anchor to their entry price, refusing to accept that the market has moved on. "It'll come back to my entry," they tell themselves, as if the market owes them a return to equilibrium. Anchoring freezes flexibility and locks perception into outdated narratives. Another deeply ingrained bias is the gambler's fallacy, the belief that past outcomes influence future probabilities in random systems. A trader who loses 5 times in a row may believe they're due for a win, even though each trade is independent. This fallacy breeds revenge trading and emotional risk-taking. The brain seeks balance, but markets do not operate on fairness, they operate on probability. The gambler's fallacy arises from the human desire for symmetry and justice, the same instinct that makes us think streaks must eventually even out. In trading, acting on this belief is often catastrophic. It leads to oversized bets, impulsive entries, and irrational confidence at precisely the wrong moment. Perhaps one of the most dangerous biases in trading is the self-attribution bias, the tendency to attribute success to skill and failure to external factors. When a trade wins, the trader feels brilliant. When it loses, they blame manipulation, news events, or bad luck. This bias protects self-esteem but prevents growth. By externalizing failure, the trader avoids responsibility. By internalizing success, they inflate ego. Over time, this creates a distorted feedback loop where learning becomes impossible. The trader continues repeating the same mistakes, convinced the problem lies outside themselves. True progress begins only when this bias is broken, when the trader accepts that every decision, win or lose, reflects their process, not the market's benevolence or cruelty. Another bias, the optimism bias, keeps traders believing they will succeed even when statistics and behavior suggest otherwise. This is why traders often risk more than they can afford, convinced they'll be the exception. The mind projects an idealized version of the future to escape present discomfort. This bias can be motivating in moderation, but in trading, it leads to delusion. The optimism bias blinds traders to risk and reinforces unrealistic expectations. When losses come, the emotional crash is devastating because it doesn't just threaten capital, it threatens identity. The trader must confront not only financial failure but the collapse of their imagined future. Hindsight bias compounds this pain. After a move occurs, traders convince themselves they knew it all along. They rewrite memory to fit outcome, strengthening the illusion of control. This bias is insidious because it distorts learning. The trader no longer sees the true causes of outcomes but constructs narratives that confirm their intelligence. They forget the uncertainty that existed before the trade and replace it with false clarity. This makes future preparation weaker because lessons are built on illusion. Hindsight bias keeps traders trapped in a loop of emotional storytelling rather than statistical truth. Cognitive biases rarely appear in isolation. They weave together into patterns that reinforce one another, creating psychological traps that feel logical in the moment. A trader suffering from confirmation bias may also fall into overconfidence, fueled by illusion of knowledge. Loss aversion can blend with sunk cost fallacy, making exits emotionally impossible. Recency bias may amplify gambler's fallacy, creating a spiral of reactionary decisions. Each bias strengthens the others, building a mental echo chamber that blinds the trader to objective reality. The more emotionally charged the situation, the more powerful these biases become. Under stress, the brain reverts to instinct, not logic. This is why traders often say they knew better but acted otherwise. Their emotional brain overpowered their analytical one. The influence of cognitive bias extends beyond the trade itself into the trader's broader mindset. Biases shape not only decisions but also beliefs about the market and self. They determine how a trader interprets randomness, how they construct meaning from chaos, how they relate to uncertainty. A trader dominated by bias does not see the market as it is, but as they are. Every price movement becomes a reflection of internal narrative hope, fear, ego, insecurity. The market becomes a psychological mirror, reflecting biases back at magnified scale. Those who fail to recognize this spend their careers fighting phantoms, mistaking emotional projection for market truth. In truth, the mastery of trading psychology lies not in eliminating bias, for that is impossible, but in recognizing it as it arises. Awareness does not remove bias, but it dilutes its power. When a trader notices their mind searching for confirming evidence, they can pause. When they feel emotional resistance to cutting a loss, they can name it as loss aversion. When they sense excitement after a win, they can recognize overconfidence before it takes root. This awareness transforms bias from master to messenger, a signal revealing where emotion has overtaken objectivity. The trader who learns to observe these internal distortions gains an advantage no chart can offer: the ability to see clearly, not just outwardly, but inwardly. Among all psychological pitfalls that entangle traders, none is more deceptive or pervasive than the illusion of control. It is the deeply rooted belief that one can influence or predict the outcome of inherently uncertain events. In trading, this illusion doesn't simply appear as arrogance or ignorance, it emerges from a psychological need. Humans crave certainty. We need to believe that our actions have meaning, that our choices shape results. This instinct once served as a mechanism for survival, giving us the courage to hunt, build, and plan. But when this ancient impulse is projected into the probabilistic world of financial markets, it becomes a mental trap, one that convinces traders they can command the uncontrollable and master randomness through sheer will or intelligence. The illusion of control often begins subtly, almost invisibly, during a trader's early encounters with success. A few winning trades create a sense of mastery, a belief that the market can be tamed through skill and effort. This belief grows quickly because the brain is wired to associate outcomes with actions. When a trader makes a decision, enters a position, sets a stop, takes profit, and the outcome is favorable, the mind naturally links that success to the decision itself. The randomness that contributed to the win fades from awareness. The mind takes credit, and in doing so, reinforces the illusion of personal agency. This connection is intoxicating because it offers psychological comfort in an environment defined by uncertainty. It tells the trader, "You have control," when in truth, all they have is influence over process, not outcome. As the trader becomes more involved in the markets, this illusion deepens. The sheer amount of available data, charts, news, indicators, economic releases, amplifies the perception of control. The modern trading environment reinforces this delusion by providing endless analytical tools and real-time updates. Platforms simulate mastery by letting traders manipulate screens, draw patterns, and execute instant orders. Each click gives a sense of agency, a momentary belief that mastery over data equals mastery over direction. But these tools, for all their sophistication, do not change the core truth. Markets are chaotic systems influenced by countless variables beyond any individual's reach. The illusion persists, not because it is true, but because it feels safer than admitting helplessness. This psychological safety is critical to understand. The illusion of control acts as a shield against existential discomfort. Uncertainty is inherently stressful. The human nervous system is not designed for prolonged ambiguity. We crave closure, explanation, and cause and effect order. When we cannot find it, we invent it. Traders do this unconsciously, attributing patterns to randomness, meaning to noise, and predictability to probability. This is why traders often believe certain setups or indicators have power, even when their success rate is statistically inconsistent. The brain prefers a comforting illusion to an unsettling truth. It is less painful to believe that one can predict the market than to accept that no one can. This illusion is reinforced through cognitive biases such as hindsight bias and self-attribution bias. After a trade plays out, the trader's mind rewrites history. If the trade succeeded, the memory of uncertainty fades and is replaced by a sense of foresight. The trader begins to believe they saw it coming, even if they hesitated or guessed. This post-event rationalization builds the myth of control. Similarly, when trades fail, traders often externalize blame on news, manipulation, or bad timing, protecting the illusion that they were still right in principle. Over time, this mental pattern becomes automatic. The trader constructs an inner narrative of competence and consistency, even when performance metrics suggest randomness. The mind prefers coherence to accuracy, and so the illusion deepens. At a biological level, this phenomenon is linked to the dopamine system. Every time a trader experiences a perceived moment of control, successfully predicting a move or executing a planned trade, the brain releases dopamine. This reward reinforces the behavior, making the trader more likely to repeat it. It's the same mechanism that drives addictive behaviors. The trader becomes addicted not just to winning, but to the feeling of mastery. This addiction blinds them to the truth that control is partial, conditional, and fragile. As long as the outcome aligns with expectation, the illusion feels justified. When the market inevitably defies expectation, the resulting psychological pain is not just financial, it is existential. The trader must confront the collapse of control, and with it, the collapse of identity. This confrontation often manifests as frustration and anger. Traders lash out at the market, accusing it of being irrational or manipulated. These statements are not objective observations but emotional defenses. They reveal the ego's struggle to maintain the illusion. The idea that the market is wrong feels safer than admitting one's own powerlessness. In this way, the illusion of control protects the ego from disintegration. The trader identifies with their analysis, their predictions, their skill set. When those fail, it feels like personal failure, so the mind projects blame outward. The irony is that the harder a trader clings to control, the more emotionally reactive they become when it is violated. Their psychological stability becomes tied to external validation, and the market, a force of infinite uncertainty, becomes their emotional regulator. The illusion of control also shapes behavior in more subtle ways. It influences position sizing, risk management, and trade frequency. Traders who believe they can control outcomes often take larger risks than they should. They increase position sizes after wins, assuming their read on the market is improving, when in fact, their confidence is inflating. They reduce stops or remove them altogether, because they believe they can manage the trade manually. They overtrade, convinced that more activity equals more opportunity. Each of these behaviors stems from the same root, the belief that skill can neutralize uncertainty. The reality is the opposite. In trading, skill manages uncertainty but never eliminates it. Yet the illusion persists because it feeds emotional comfort, and comfort feels like control. Another manifestation of this illusion appears in the obsession with prediction. Many traders believe that if they analyze deeply enough, they can forecast what will happen next. They study patterns, indicators, and sentiment data, believing these tools reveal certainty. But the market is not a puzzle to be solved. It is a dynamic ecosystem shaped by collective human behavior. Patterns repeat not because of hidden laws but because of recurring psychology, fear, greed, and expectation. Prediction gives the illusion of control because it frames randomness as order. The mind feels safer, believing the market makes sense, even if that sense is retroactively imposed. In truth, the most successful traders are not predictors but probabilists. They understand that control lies not in knowing what will happen, but in managing what they will do when it does. The illusion of control is also fed by cultural narratives. Society glorifies mastery, discipline, and achievement. The idea that effort and intelligence yield proportional reward is ingrained from childhood. This belief works well in structured domains: education, career, sports, but collapses in stochastic systems like markets. Here, effort does not guarantee success. Knowledge does not ensure outcome. Yet the trader's ego resists this reality. The harder they work, the more entitled they feel to results. When results don't come, cognitive dissonance arises. To resolve it, the mind clings harder to the illusion of control, often leading to burnout or emotional collapse. The trader begins to oscillate between extremes: obsession and despair, both fueled by the same delusion, that control should exist where it doesn't. One of the most profound dangers of the illusion of control is how it distorts perception of randomness. The human mind struggles to accept randomness as truly random. It constantly searches for patterns, even in noise. This is known as apophenia, the tendency to perceive meaning in meaningless data. In trading, apophenia manifests as pattern overfitting. Traders see head and shoulders formations where none exist, interpret random volatility as signals, and believe certain times or days have predictive value. This pattern recognition is not analytical but emotional, the brain's attempt to impose order on chaos. It gives comfort, the feeling of understanding, but in truth, it is illusion wrapped in logic. The trader becomes addicted to pattern recognition, confusing correlation with causation, and narrative with truth. The illusion extends even further into risk perception. Traders often believe they can manage risk in the sense of eliminating it, rather than accepting and containing it. They equate stop-loss orders and risk-reward ratios with safety. While these tools are essential, they do not guarantee protection, they only define boundaries. A sudden market gap, a flash crash, a liquidity event, these are reminders that control is conditional. Yet each time the trader survives such an event, they convince themselves they can handle it next time, reinforcing the illusion. The brain selectively remembers survivorship, not fragility. It celebrates the moments when control seemed effective and suppresses the moments when it failed. Over time, this illusion becomes a silent dictator within the trader's psyche. It dictates behavior, emotional reaction, and even belief systems. The trader who clings to control becomes rigid, unable to adapt when markets shift. They defend their strategies long after they've stopped working. They become trapped in mental narratives. The market will turn soon. This setup always works. It can't go lower. These statements are not strategies, they are prayers disguised as logic. The trader has mistaken conviction for control, faith for discipline. The illusion becomes self-reinforcing because each temporary success confirms it, while each failure is dismissed as anomaly. The illusion of control does not only distort individual perception but also collective behavior. In periods of market euphoria, entire crowds succumb to it simultaneously. Bubbles form when masses of traders believe they understand and control the market's direction. Everyone becomes an expert, every dip feels like opportunity, and every warning is ignored. This collective delusion magnifies risk while minimizing fear. The illusion of control becomes cultural, a shared hallucination that grows until reality breaks it. When the crash comes, disbelief follows. Traders ask, "How could this happen?" as if markets owe them consistency. In truth, they mistook confidence for control and participation for protection. To understand how deeply this illusion runs, one must examine the emotional anatomy of a single trade. Before entry, the trader feels excitement mixed with anticipation, a sense of potential mastery. During the trade, each tick that moves in their favor reinforces belief in control. When it moves against them, they interpret it as temporary noise. The illusion bends perception to maintain comfort. When the trade closes profitably, the brain connects the dots. Action led to success, even though randomness played its part. When the trade fails, the brain seeks excuses, preserving the narrative of control. In this way, every trade, win or lose, strengthens the illusion. It becomes a closed psychological loop. The illusion of control persists because it fulfills an emotional need stronger than the desire for accuracy, the need for agency. Humans would rather believe in partial control than face the abyss of chaos. Admitting lack of control triggers vulnerability, a primal fear of helplessness. So the trader creates rituals, checking charts obsessively, analyzing indicators repeatedly, rewatching entries, studying forecasts. These behaviors mimic control but provide none. They offer comfort, not certainty. The trader feels prepared, but preparation does not equal prediction. The ritual satisfies the psyche, not the probabilities. In the end, what sustains the illusion is the market itself. Its intermittent reinforcement. The market sometimes rewards bad behavior and punishes good decisions. This randomness confuses feedback, making it easy to misinterpret outcomes. A trader might violate every rule and still profit, convincing themselves their instinct is superior. Another may follow their plan precisely and lose, doubting their system. This inconsistency keeps the illusion alive. Like a slot machine, the market gives just enough reward to maintain hope. The trader remains trapped in the belief that control can be mastered if they just try harder, study longer, or focus deeper. In the volatile world of trading, where fortunes are built and destroyed within seconds, emotional detachment becomes not a luxury but a necessity. It is the thin psychological barrier that separates those who endure from those who collapse, under the invisible weight of their own emotions. Every chart, every trade, every tick, is not just a reflection of market activity, it is a mirror of the trader's inner state. Fear, greed, excitement, anxiety, regret, all of these emotions surge and recede like tides, constantly testing one's discipline. And within this psychological battlefield, emotional detachment is the only weapon that allows clarity amid chaos. But detachment does not mean indifference or apathy. It is a deliberate discipline, a cultivated distance between what one feels and what one does. It is the ability to act based on process rather than impulse. To understand emotional detachment, one must first understand why emotion is so deeply tied to trading behavior. The human brain evolved to survive, not to trade. Our ancestors learned to react quickly to threats and opportunities. When faced with danger, the fight or flight mechanism kicked in, flooding the body with adrenaline, heightening awareness, and prioritizing immediate survival over rational thought. In trading, this same mechanism misfires. A sudden price drop feels like danger, a spike feels like opportunity. The body reacts before the mind can reason. Heart rate increases, breathing quickens, muscles tense. The trader becomes reactive, not analytical. Emotional detachment, therefore, begins with the understanding that the mind must be trained to operate in an environment its biology was never designed for. This detachment is not achieved through suppression. Many traders mistakenly believe that emotional control means ignoring or denying feelings. But suppression only strengthens emotion. What is resisted persists. Instead, emotional detachment begins with awareness, the capacity to observe emotion without identification. A trader may feel fear but does not act on it. They acknowledge the emotion as part of the experience, not as truth. They see excitement rise after a winning streak and recognize it as a signal of potential overconfidence. This self-awareness becomes a meta-skill, a form of emotional intelligence that separates professional traders from impulsive ones. Emotional detachment is less about eliminating emotion and more about transcending it. The process of developing this detachment is deeply psychological and often uncomfortable. It requires confronting the ego, the part of the self that craves validation through outcomes. Every trader's ego wants to be right. Every win feeds it, and every loss wounds it. The ego ties self-worth to performance, creating an emotional dependency on results. Detachment, however, requires dismantling this relationship. It means separating identity from outcome, understanding that a losing trade does not make one a failure, just as a winning trade does not make one a genius. It requires shifting focus from being right to executing correctly. The process, not the result, becomes the metric of success. This shift in perspective is where true detachment begins to form. To achieve this mindset, a trader must anchor themselves in structure, a predefined system of behavior that reduces emotional interference. This is the essence of process. A process is a framework of rules, strategies and habits designed to standardize decision-making under stress. It removes the need for constant emotional interpretation. When the market moves violently, a trader without a process reacts to feelings, a trader with one reacts to data. The process acts as a buffer, insulating the trader from impulsive choices. It might dictate position sizing, entry and exit criteria, risk management protocols, and journaling routines. Each element serves as a stabilizer, preventing emotional extremes from hijacking logic. But structure alone is not enough. Many traders have rules, few follow them consistently. Emotional detachment requires not just having a process but surrendering to it. This surrender is paradoxical because it feels like loss of control, yet it is the foundation of mastery. By trusting the process, the trader relinquishes the illusion of micromanaging outcomes. They understand that control exists only in preparation and execution, never in the result. The outcome belongs to the market, the discipline belongs to the trader. This surrender creates psychological freedom. The trader no longer feels compelled to force trades, chase losses, or overanalyze results. They become a participant, not a victim, of uncertainty. Consistency is the psychological soil in which detachment grows. The more a trader repeats their process with discipline, the more predictable their emotional responses become. Over time, the nervous system learns to associate routine with safety. The market's volatility becomes less threatening because the trader knows how to respond. This is why routine journaling trades, reviewing setups, maintaining a trading schedule is not just administrative, it is therapeutic. It gives the mind structure, and structure gives emotion boundaries. Within those boundaries, detachment thrives. A significant part of emotional detachment also comes from understanding probability. Most traders intellectually know that trading is a game of probabilities, but few internalize it emotionally. The human mind is conditioned to seek certainty, to believe that every decision should yield a predictable result. But markets do not conform to linear logic. Even a perfect setup can fail, and even a reckless trade can succeed. Detachment requires embracing this truth completely, understanding that outcomes are random in the short term, but shaped by consistency in the long term. The process, therefore, becomes the trader's compass amid randomness. When a trade fails, it is not a threat to identity. It is a single data point within a larger statistical framework. To internalize this probabilistic mindset, traders must learn to view losses differently. Losses are not mistakes, they are the cost of doing business. Emotional detachment means treating losses with neutrality, neither dramatizing them nor dismissing them. Each loss provides information not about one's worth, but about one's execution. The emotionally detached trader studies losses like a scientist studies data, objectively, curiously, without judgment. They ask not, "Why did this happen to me?" but, "What does this reveal about my process?" This shift from personal to procedural thinking dismantles emotional turbulence. The trader ceases to oscillate between euphoria and despair, because they no longer interpret results as personal narratives. A crucial aspect of achieving detachment is mindfulness, the ability to remain present in the moment without being dominated by it. Mindfulness allows traders to observe fluctuations in both market and mind without overreacting. It cultivates the gap between stimulus and response, that brief pause where awareness lives. In that pause, clarity emerges. The mindful trader notices when fear arises before pressing the sell button, when greed whispers after a big win, when boredom tempts overtrading. They do not suppress these impulses, they observe them. Over time, observation weakens identification. The emotion passes like a wave, and the trader remains still. This stillness, developed through mindfulness, becomes the foundation of emotional neutrality. Journaling is another powerful tool in cultivating detachment. By recording trades, thoughts, and emotions, traders externalize their internal experience. They turn feelings into data, transforming subjective chaos into objective reflection. A well-kept trading journal reveals patterns of behavior that might otherwise remain unconscious. It shows how emotion influences decision-making, how impatience leads to premature exits, how frustration fuels revenge trading, How overconfidence distorts perception after winning streaks. Awareness born from journaling creates distance between impulse and action. Over time, this distance solidifies into detachment. The trader begins to see themselves not as a victim of emotion, but as an observer of it. Detachment also grows from embracing uncertainty as a constant companion rather than an enemy. The emotionally reactive trader fights uncertainty, seeking ways to eliminate it through prediction and control. The emotionally detached trader accepts uncertainty as the essence of trading. They do not fear it, they prepare for it. They manage position sizes, diversify exposure, and define risk not to avoid loss but to coexist with it. This acceptance transforms anxiety into calm readiness. The market ceases to be an adversary and becomes an environment, one that cannot be conquered but can be navigated through composure and awareness. Another dimension of emotional detachment lies in redefining success. Most traders equate success with profit, but this definition traps them in emotional dependency. As long as profit remains the measure of worth, emotion will rule decision-making. Detachment requires redefining success as flawless execution of process, regardless of outcome. A trader who followed their plan and took a loss has succeeded. A trader who broke their rules and profited has failed. This redefinition rewires the emotional relationship with trading. It shifts motivation from external validation to internal integrity. The trader begins to experience satisfaction not from winning, but from mastery, the quiet confidence of acting in alignment with their principles. The path to emotional detachment is also paved with self-compassion. Trading is psychologically punishing because it exposes human flaws with brutal immediacy. Impatience, fear, greed, ego, all are magnified by the market's mirror. Many traders respond to mistakes with self-criticism, believing that punishment breeds discipline. But harshness does not create strength. It breeds shame and rigidity. Self-compassion, on the other hand, allows resilience. It enables the trader to recover quickly from mistakes without internal collapse. Detachment requires this gentleness, the understanding that perfection is impossible, and that learning is continuous. It allows the trader to remain emotionally stable amid inevitable errors. It is also essential to recognize that emotional detachment is not static, it fluctuates. Even the most disciplined traders experience emotional interference. The goal is not permanent neutrality but rapid recovery. When emotions take over, detachment allows a quick return to balance. It transforms emotional reactivity into emotional awareness. This adaptability is what defines long-term success. The market's rhythm changes, volatility shifts, and trends evolve, but the emotionally detached trader remains consistent because their anchor lies within, not in external conditions. Time, experience, and deliberate practice are the silent architects of emotional detachment. With every trade, every cycle of gain and loss, the trader learns more about their own psyche. The market becomes a teacher, not an opponent. Each emotional reaction reveals a lesson, where patience falters, where discipline cracks, where attachment forms. The trader who uses these experiences for introspection gradually develops emotional immunity. The highs no longer intoxicate, the lows no longer devastate. What remains is equanimity, a steady, composed presence that observes without being consumed. Ultimately, emotional detachment through process is the evolution of the trader's consciousness. It is the transition from reactive to reflective, from impulsive to intentional. It transforms trading from a battle against the market to a practice of inner mastery. Through structure, mindfulness, journaling, and acceptance, the trader learns to act from clarity rather than emotion. The process becomes not just a method for trading, but a framework for living, one that replaces chaos with calm, attachment with awareness, and noise with stillness. The emotional roller coaster of trading is not something that can be stopped by force or conquered by intellect. It is an experience that every trader must live through. A psychological storm that reveals both the fragility and resilience of the human mind. But there comes a moment, after the endless cycles of euphoria and despair, of overconfidence and fear, when a trader begins to glimpse the truth that the market is not something to be tamed but something to be understood. The way off the ride is not an escape from emotion, but an awakening through it. It is a journey of transformation, where the trader ceases to fight the market and begins to master themselves. The road to that mastery is not paved with new strategies or secret indicators, but with self-awareness, acceptance, and surrender to the reality of uncertainty. The first step toward getting off the emotional roller coaster begins with recognition, the realization that the market is not the cause of emotional turmoil, but merely the mirror that reflects it. Every spike of fear, every surge of greed, every pang of regret is not born in the market but within the trader. Prices move, but it is the trader who assigns meaning to those movements. A green candle does not create joy, it triggers it. A red candle does not create panic, it awakens it. The trader's mind becomes the interpreter of chaos, turning neutral information into personal drama. When this is understood deeply, something profound shifts. The trader stops blaming the market and begins observing themselves. They start to see that emotional volatility is not a market condition but a mental one. This awareness alone does not bring peace, but it is the foundation for it. Most traders live in a reactive state, constantly pushed and pulled by the market's fluctuations, driven by hope one moment and by fear the next. They think they are responding to the market, but in truth, they are responding to their own emotions about it. Awareness breaks this automatic loop. The trader learns to pause, to witness the surge of emotion without immediately acting on it. This pause, this single breath between impulse and response, is the seed of emotional freedom. Within it lies the power to choose. To choose patience over panic, discipline over impulse, and observation over reaction. The market will always move, but choice gives the trader the ability to remain still. As awareness deepens, the trader begins to see patterns not just on charts but within themselves. They notice that fear arises not because of volatility but because of uncertainty. They recognize that greed appears not because of opportunity but because of attachment. These insights begin to dissolve the illusion of external causation. The trader realizes that emotions are not enemies to be suppressed but signals to be understood. Fear signals overexposure or lack of preparation. Greed signals ego or attachment to outcome. Frustration signals resistance to reality. Each emotion, when observed consciously, reveals information about the trader's state of mind. The emotional roller coaster, once seen as punishment, becomes a teacher. Acceptance follows awareness. Acceptance is the art of allowing what is both in the market and within oneself. It means acknowledging that uncertainty is not a flaw of trading, but its essence. The market cannot be predicted, controlled, or forced into compliance. It operates in probabilities, not certainties. Accepting this truth ends the futile war between expectation and reality. The trader learns to approach each trade with humility, understanding that even the best setup can fail and even the worst can succeed. Acceptance liberates the trader from emotional dependence on outcomes. Wins are no longer proof of brilliance, losses are no longer proof of inadequacy. They are simply results, data points in a larger process. But acceptance must also extend inward. Traders must accept their own humanity. The fact that they will make mistakes, feel fear, and experience doubt. Many traders live under the tyranny of perfectionism. They expect themselves to be robotic, emotionless, and flawless. When they inevitably fall short, they spiral into guilt and frustration. This self-rejection only strengthens emotional volatility. Acceptance dissolves it. To accept one's emotions does not mean to indulge them, but to acknowledge them without judgment. It is saying, I feel fear right now, and that's okay. Instead of, I shouldn't be feeling this. In that simple shift from resistance to acknowledgement, emotion loses its grip. The trader becomes free to act rationally even while feeling irrational impulses. The way off the ride also requires detachment from outcome, a concept that sounds simple in theory but challenges every fiber of human psychology. Outcome attachment is the root of emotional turbulence. When a trader ties their self-worth, confidence, or happiness to results, they become enslaved by the market. Every profit boosts identity, every loss wounds it. Detachment means untangling this relationship. It means seeing trading as a process, not a scorecard. The trader's worth is measured not by profit, but by consistency in following their plan. This shift from outcome to process transforms emotional volatility into stability. When the focus is on execution rather than result, emotion loses its power to dictate behavior. This detachment, however, is not apathy. It is active presence, full engagement without emotional ownership. The detached trader still cares deeply about their craft. They simply stop identifying with each outcome. They trade not to prove something but to practice something. Every trade becomes an act of alignment with principles, patience, discipline, awareness. When trades succeed, gratitude replaces euphoria. When they fail, curiosity replaces despair. The trader no longer rides the emotional highs and lows because they no longer define themselves by them. Detachment, in this sense, is not the absence of emotion but the transcendence of it. A crucial component in this transformation is mindfulness, the conscious awareness of the present moment. Mindfulness trains the trader to remain centered amid volatility. It cultivates a state of non-reactivity, where observation replaces identification. A mindful trader can watch a position move against them without collapsing into panic, because they recognize that panic is not truth, only sensation. They breathe through it, letting it rise and pass. They can watch profits grow without being seduced by greed, because they see greed as a wave, not a command. Mindfulness teaches the trader that emotion is transient, but awareness is constant. This awareness becomes the anchor that stabilizes them in the storm of uncertainty. Alongside mindfulness comes the power of routine, a structure that grounds the trader in discipline. Routine is the external manifestation of internal order. It creates consistency where emotion seeks chaos. Pre-market preparation, journaling, post-trade review. These are not mechanical tasks but psychological rituals that reaffirm control over process, not outcome. The repetition of these routines rewires the mind, teaching it to find stability in structure rather than in results. Over time, this discipline becomes a form of meditation. The trader wakes, prepares, analyzes, trades, and reflects not out of compulsion but out of rhythm. The mind begins to move with the market without being moved by it. The way off the emotional ride also involves redefining one's relationship with uncertainty. Most traders fear uncertainty because they mistake it for danger. But uncertainty is not a threat, it is the natural state of the market and of life itself. Every trade, every moment, every breath unfolds in uncertainty. The attempt to eliminate it only breeds more fear. Freedom arises when the trader learns to coexist with it, to flow with it rather than fight it. Uncertainty becomes not something to escape but something to dance with. This acceptance transforms fear into alertness, transforming anxiety into awareness. The trader ceases to resist what they cannot control, and instead directs their energy toward what they can: preparation, risk management, and self-regulation. Letting go of the illusion of control is one of the most liberating moments in a trader's psychological evolution. It is the recognition that the market does not reward effort, intelligence, or passion, it rewards discipline and adaptability. The trader cannot control the outcome of any trade, but they can control how they respond to it. This understanding shifts the focus inward. Emotional regulation becomes the true measure of progress. The trader learns that mastery is not about predicting direction, but about maintaining composure regardless of it. The illusion of control dissolves, replaced by inner equilibrium. This equilibrium is not cold detachment, but serene engagement, the ability to be fully involved without being emotionally consumed. Journaling becomes an essential companion on this path. By documenting thoughts, emotions, and decisions, the trader externalizes their inner dialogue. The act of writing transforms chaos into clarity. Patterns emerge not of the market, but of the mind. The trader sees how emotion arises, how it influences behavior, and how discipline erodes under pressure. This awareness turns journaling into a mirror of consciousness. Each entry becomes a conversation between the trader and their evolving self. Over time, the journal tells a story of transformation from reactivity to reflection, from chaos to composure. It becomes evidence of growth, a record of the slow but certain dismantling of emotional dependency. The way off the ride also requires the cultivation of patience. Patience is not passive waiting, it is active discipline. It is the willingness to allow the market to unfold without forcing it. Impatience is the emotional residue of attachment, the mind's refusal to accept the pace of reality. The impatient trader seeks constant action, mistaking movement for progress. But markets reward observation, not impulsivity. Patience allows space for clarity. It prevents overtrading, protects capital, and nurtures calm. Each moment of restraint strengthens the trader's psychological muscles, reinforcing their ability to stay grounded amid temptation. Resilience is another cornerstone of emotional freedom. No trader escapes losses, but not every trader learns from them. Resilience transforms pain into perspective. It allows the trader to absorb shocks without breaking. Emotional resilience is not born from avoiding loss but from embracing it with grace. It is the quiet strength that says, "This too shall pass." The resilient trader views drawdowns as temporary, not defining. They recover quickly, not because they feel nothing, but because they understand that emotions, like markets, move in cycles. What rises will fall, and what falls will rise again. This cyclical understanding of emotion brings peace, teaching the trader that stability lies not in avoiding fluctuation but in coexisting with it. Another profound step on this journey is the integration of self-awareness beyond trading. Many traders compartmentalize their market behavior, believing it exists in isolation. But trading psychology is not separate from life psychology. The same patterns that appear in trading, impatience, fear, control, validation seeking, appear everywhere else. Trading simply magnifies them. The market becomes a mirror reflecting the trader's deepest traits. The way off the ride, therefore, extends beyond charts and into consciousness. As traders evolve psychologically, they begin to see trading not as a financial endeavor, but as a path of self-discovery. Each emotional challenge becomes an opportunity for growth. Each setback becomes a mirror showing where ego still clings, where fear still hides, where attachment still binds. In this sense, trading becomes meditation in motion, an ongoing practice of awareness, surrender, and adaptation. Every trade is a chance to practice presence. Every fluctuation tests composure. The market, indifferent and ever-changing, becomes a spiritual teacher disguised as a financial system. It rewards not those who dominate it, but those who harmonize with it. The trader who reaches this state is no longer driven by greed or fear but by curiosity and clarity. They understand that the goal is not to control the market but to master the self that engages with it. The way off the emotional roller coaster is not an exit but a transformation of perspective. It is not about escaping the experience but about evolving within it. The trader who once sought control learns acceptance. The one who once chased emotion learns stillness. The one who once fought uncertainty learns to dance with it. The market remains the same, but the trader has changed. And in that change lies the quiet freedom that every trader seeks, not freedom from volatility, but freedom from the need to escape it. At the end of every trader's journey, after the highs and lows, after the endless cycle of winning and losing, there arrives a quiet moment of reckoning. It is not marked by triumph or collapse but by understanding. The trader begins to see that the market was never truly an opponent to be conquered, nor a puzzle to be solved. It was a reflection, a living, breathing mirror that exposed every fragment of their own mind. The charts, the numbers, the movements of price, all of it was language, a dialogue between logic and emotion, between external volatility and internal stillness. The destination was never wealth alone, it was awareness. The journey of trading is, in truth, a journey inward, toward the integration of mind and market. This integration does not happen in an instant. It unfolds gradually, like the slow clearing of fog after a long storm. The trader who once looked outward for certainty to strategies, to signals, to experts, begins to look inward instead. They realize that while the market's behavior cannot be controlled, their own reactions can be understood, refined, and mastered. The line between analysis and psychology fades. Discipline becomes meditation. Strategy becomes expression. The trader no longer divides themselves between thinker and feeler, analyst and dreamer. Both parts coexist in harmony, each informing the other. Logic provides the framework, emotion provides the energy, and awareness unites them into balance. At this point, trading transforms from pursuit to practice. It ceases to be a constant chase for profit and becomes an ongoing dialogue with uncertainty. The trader learns to sit with the discomfort of not knowing. They no longer seek to outsmart the market but to understand its rhythm, its impermanence. Each candle on the chart becomes a lesson in patience, Each fluctuation becomes a reminder of transience. The market's unpredictability, once a source of fear, becomes a teacher of humility. The trader learns to flow with it, to adapt without resistance, to accept without surrendering awareness. They understand that success in trading is not defined by accumulation but by alignment. Alignment between thought, emotion, and action. This alignment is what the ancient philosophers might have called harmony of the self. When the mind is divided, the trader suffers. When the mind is integrated, the trader acts effortlessly. There is no longer conflict between wanting and knowing, between feeling and deciding. The trader observes without judgment, acts without hesitation, and accepts without resistance. This state of integration is not mystical, it is deeply practical. It manifests in consistent behavior, disciplined execution, and emotional calm. The trader no longer oscillates between extremes of confidence and fear. They find equilibrium not because the market has changed, but because their perception has. In the quiet rhythm of integrated trading, decisions become less about control and more about connection. The trader feels the market as a living system, a vast, collective expression of human behavior. Every tick is the sum of millions of choices, fears, hopes, and reactions. To trade within it is to participate in the psychology of the world. The integrated trader respects this complexity. They no longer impose their will upon the market but listen to it, adapt to it, and align with it. Trading becomes less a battle and more a conversation, one in which silence is often more powerful than speech, patience more rewarding than aggression. The psychological transformation that leads to this state often leaves traces across every part of life. The emotional intelligence cultivated through trading, the ability to stay calm under pressure, to manage uncertainty, to remain present begins to extend beyond the screen. Relationships, decisions, and daily experiences all begin to shift. The trader who once sought external validation learns the quiet strength of internal confidence. The need to win is replaced by the need to grow. The market ceases to be an escape or obsession and becomes a reflection of how one engages with the world itself. The discipline that once applied to charts becomes a philosophy of being, a way of living consciously, moment to moment, without clinging to outcome. There is an invisible beauty in this transformation, though it is often overlooked. It lies in the realization that failure was never the opposite of success but its foundation. Every loss, every emotional collapse, every mistake that once felt unbearable was part of a larger refinement. The market, in its unfeeling indifference, had been shaping the trader, sanding down arrogance, exposing bias, teaching patience. It was never punishing, it was revealing. The process of trading, with all its pain, becomes a kind of apprenticeship in awareness. Those who stay long enough to endure its lessons emerge not just as better traders but as more grounded human beings. They carry within them a stillness forged through chaos. In this stillness, something extraordinary happens. The trader begins to experience moments of effortless flow. These are the times when analysis, intuition, and execution align seamlessly. There is no hesitation, no overthinking, no emotional noise. The mind moves with the market, not against it. This state cannot be forced, it arises naturally when preparation and presence meet. The trader recognizes it not by excitement but by calm, the deep, unshakable calm of knowing they are exactly where they need to be, doing exactly what they need to do. In that moment, profit and loss lose their meaning. There is only awareness, precision, and flow. Yet even within this evolved state, the trader knows the cycle never truly ends. The mind will still be tested. Emotion will still arise. The difference is that now these fluctuations are no longer threats. They are accepted as part of the experience. The trader no longer seeks to eliminate emotion but to integrate it. Fear becomes caution. Excitement becomes energy. Regret becomes wisdom. Emotion ceases to be the enemy and becomes an ally. The integrated trader does not suppress feeling but channels it, transforming raw emotion into refined awareness. This alchemy, the turning of reactivity into reflection, is the essence of mastery. Mastery in trading, then, is not about the external world of charts, systems, or profits. It is about the internal alignment that allows one to engage with the external world without distortion. The trader who has walked through the fire of emotion and emerged aware knows that consistency comes not from controlling the market but from controlling the self. They understand that every decision is a reflection of internal state. When the mind is calm, the strategy works. When the mind is chaotic, no system can save it. The real edge is psychological, the ability to remain balanced when everything outside demands reaction. At this stage, detachment and connection coexist. The trader is detached from outcome but deeply connected to process. They can experience large wins and losses without emotional turbulence because their sense of identity no longer depends on them. Profit becomes feedback, not validation. Loss becomes data, not defeat. Each day in the market is simply another opportunity to practice awareness, to observe the interplay between mind and market with honesty and humility. The trader becomes both participant and witness, both student and master, both analytical and intuitive. This duality, this integration is what ends the roller coaster. In the quiet reflection of this realization, a kind of gratitude emerges. The trader begins to appreciate the market not for what it gives or takes, but for what it teaches. Gratitude replaces greed, humility replaces ego, and patience replaces urgency. The market becomes a mirror through which one learns to see the self more clearly. Every trade, every fluctuation, every emotional response becomes part of a greater unfolding, a process of inner refinement that transcends profit and loss. The trader sees that success was never about predicting the next move, but about understanding the one making the move themselves. And so, the journey that began with excitement and ambition transforms into one of awareness and equanimity. The market remains unpredictable, as it always has been, but the trader no longer fears it. They no longer ride the emotional highs and lows. They observe them with calm detachment. Their decisions are deliberate, their reactions minimal, their understanding deep. They do not seek control, because they have learned that control is an illusion. What they seek and what they find is harmony. Harmony between analysis and instinct, between risk and patience, between uncertainty and acceptance. It is in this harmony that the trader finds the way off the ride, not by escaping it, but by realizing they were never truly trapped on it to begin with.